Hello and welcome to The Intelligencer. Economics is a social science that focuses on the production, distribution, and consumption of goods and services, and analyzes the choices that individuals, businesses, governments, and nations make to allocate resources. Assuming humans have unlimited wants within a world of limited means, economists analyze how resources are allocated for production, distribution, and consumption. The study of microeconomics focuses on the choices of individuals and businesses, and macroeconomics concentrates on the behavior of the economy as a whole, on an aggregate level. One of the earliest recorded economists was the 8th century BC Greek farmer and poet Hesiod, who wrote that labor, materials, and time needed to be allocated efficiently to overcome scarcity. The publication of Adam Smith's 1776 book, An Inquiry into the Nature and Causes of the Wealth of Nations, sparked the beginning of the current Western contemporary economic theories. Microeconomics studies how individual consumers and firms make decisions to allocate resources. Whether a single person, a household, or a business, economists may analyze how these entities respond to changes in price and why they demand what they do at particular price levels. Microeconomics analyzes how and why goods are valued differently, how individuals make financial decisions, and how they trade, coordinate, and cooperate. Within the dynamics of supply and demand, the costs of producing goods and services, and how labor is divided and allocated, microeconomics studies how businesses are organized and how individuals approach uncertainty and risk in their decision-making. Macroeconomics is the branch of economics that studies the behavior and performance of an economy as a whole. Its primary focus is the recurrent economic cycles and broad economic growth and development. It focuses on foreign trade, government fiscal and monetary policy, unemployment rates, the level of inflation, interest rates, the growth of total production output, and business cycles that result in expansions, booms, recessions, and depressions. Using aggregate indicators, economists use macroeconomic models to help formulate economic policies and strategies. An economist studies the relationship between a society's resources and its production or output, and their opinions help shape economic policies related to interest rates, tax laws, employment programs, international trade agreements, and corporate strategies. Economists analyze economic indicators, such as gross domestic product and the consumer price index, to identify potential trends or make economic forecasts. Economic indicators detail a country's economic performance. Published periodically by governmental agencies or private organizations, economic indicators often have a considerable effect on stocks, employment, and international markets, and often predict future economic conditions that will move markets and guide investment decisions. The gross domestic product, GDP, is considered the broadest measure of a country's economic performance. It calculates the total market value of all finished goods and services produced in a country in a given year. The Bureau of Economic Analysis, BEA, also issues a regular report during the latter part of each month. Many investors, analysts, and traders focus on the advanced GDP report and the preliminary report, both issued before the final GDP figures, because the GDP is considered a lagging indicator, meaning it can confirm a trend but can't predict a trend. The Consumer Price Index, CPI, also issued by the BLS, measures the level of retail price changes and the costs that consumers pay, and is the benchmark for measuring inflation. Using a basket that is representative of the goods and services in the economy, the CPI compares the price changes month after month and year after year. This report is an important economic indicator, and its release can increase volatility in equity, fixed income, and forex markets. Greater than expected price increases are considered a sign of inflation, which will likely cause the underlying currency to depreciate. 5 economic systems illustrate historical practices used to allocate resources to meet the needs of the individual and society. In primitive agrarian societies, individuals produced necessities from building dwellings, growing crops, and hunting game at the household or tribal level. A political and economic system of Europe from the 9th to 15th century, feudalism was defined by the lords who held land and leased it to peasants for production, who received a promise of safety and security from the lord. With the advent of the Industrial Revolution, capitalism emerged and is defined as a system of production where business owners organize resources including tools, workers, and raw materials to produce goods for market consumption and earn profits. Supply and demand set prices in markets in a way that can serve the best interests of society. Socialism is a form of a cooperative production economy.
Economic socialism is a system of production where there is limited or hybrid private ownership of the means of production. Prices, profits, and losses are not the determining factors used to establish who engages in the production, what to produce, and how to produce it. Communism holds that all economic activity is centralized through the coordination of state-sponsored central planners with common ownership of production and distribution. Many economic theories have evolved as societies and markets have grown and changed. However, three disciplines of economics, neoclassical, Keynesian, and Marxian, have influenced modern society. The principles of neoclassical economics are often used as a framework to illustrate the virtues of capitalism, including the tendency of market prices to reach equilibrium as the volume of supply and demand changes. The optimal valuation of resources emerges from the forces of individual desire and scarcity. John Maynard Keynes developed the theory of Keynesian economics during the Great Depression. Arguing against neoclassical theory, Keynes showed that the restrained markets and government intervention in markets create a stable and equitable economic system and advocated for a monetary policy designed to boost demand and investor confidence during economic downturns. Marxian economics is defined in Karl Marx's work Das Kapital. Marxian economics is a rejection of the classical view of economics, arguing against the idea that the free market, an economic system determined by supply and demand with little or no government control, benefits society. He espoused that capitalism only benefits a select few and that the ruling class becomes richer by extracting value out of cheap labor provided by the working class.